Hey, Danny.
Hey, gentlemen.
Let me test my mic. 1 second. Testing. Am I coming in clear?
Yep, we hear you.
Perfect. Okay. Sounds good. All right. So we're so far we're early here.
Okay.
Let me get my screen.
Looking good, Jonathan.
Hey,
Hi,
thanks.
Jonathan.
Hello.
Let me see.
I feel like a lender again. So I'm on the top of my penthouse with my suit on. How's that?
Pretty good.
It's
I
a
put
virtual
lipstick on for
background.
you.
Yes.
That's right.
You should be able to share your screen if you want, Jonathan.
All right, cool. Let me see now. Just share. No, not that one. I'm still trying to learn these things here.
That's
Okay, wait a minute. Let me see how I can do this. I got easy. Wait, I put up my screen, but anyway. What did I click here, Danny?
so they have the green button for the share, and then you can pick what window you have open.
Oh, gotcha. All right, perfect.
Okay.
Let me see if you guys are seeing this.
Yep. You know, and then just hit the present, and you should be good.
All right.
Oh,
Okay.
I don't
There you go.
know.
Okay. Let me know when to start. All right, Danny?
Yep. We got everything set up, streaming and recording. So just give everybody a few more minutes to log in.
Gotcha.
Well, it looks like most everybody was ready to go today.
Yes. See, we got Michelle, Nina, and Carol. Nice.
And Durf's still on vacation.
Love Hawaii, Durf. It's pretty chilly today.
You go out, close the door, okay?
Okay, 5112 LM.
Okay, it's about 12:01. Danny, let
Yeah.
me know.
Yeah, go ahead. You can
Am I
get
good?
started.
Okay, all right, great. Hey guys, good afternoon, long time no see. Okay, let's get into this topic here. Loan programs and how rates are affected by credit scores. So let's start with the loan programs here. Fannie Mae Family Opportunity Mortgage. Sure some of you have heard of this. This is wherein a child of an aging parent can actually purchase a home for them using primary residence rates. So it's not going to be a second property for the child, nor is it going to be considered an investment if he purchases this for his aging parent. The child doesn't have to own or occupy the property, still get the prime rates for that. However, we need to justify why the parent does not have the ability to pay the mortgage. And we'll also have to confirm that the parent will occupy the property. With that said, then they could purchase a property, either put 10, 25% down, however it takes, as long as they meet the debt to income ratio. I had one inquiry about this not too long ago, and he was moving ahead with this type of purchase for his mom. Any questions about this program so far? All right. So if you do have, kids, that are looking to purchase for their parents, you know that we do have this program. Now, verification only or OutDoc program, or the alternative document. This is pretty popular for the self-employed because self-employed people, while they do have the cash flow, they make the income, they gross 2 million, and then they just put a net of 50, 60, 90,000, 150,000 a year, depending on how much they're purchasing. And yet they can't qualify if they go with the documented income. And you know very well that the tax preparers and CPAs are very good in having to get all those deductions in and then save them on tax. However, when they're qualifying for a home, and you know, to get the best rates, unfortunately, their documented income may be a little bit weak in order to avail of Fannie and Freddie Mac. So the bank has come up with, if you're a wage earner, VOE only, and or if you are a self-employed, this, you know, you could go with the alternative docs. What are they? For the self-employed, they need to submit at least a profit and loss statement year to date and a CPA letter, you know, confirming that they've been filing as a self-employed for the last 2 years. Now, it's a CPA letter that they need. Or there are some self-employed folks that use only a tax preparer and not the CPA. If that's the case, the tax preparer will have to prepare the letter. However, they'll have to turn that over to the CPA and to show proof to the CPA that, you know, the letter is true and correct, so that the CPA can attest to the letter that the tax preparer made. So again, if the borrower does not have a CPA or know of any CPA that could write that letter up for him, he could have his tax preparer write it up, but then we'll have to present it to a CPA to attest to that. And the CPA will have to have, you know, license and letterhead and all that in good standing. And that's acceptable. Now for VOE wage earners, these are people like maybe mechanics or other types of labor intensive type of wage earners who get paid mixed with the 1099 with plus wage. When you get 1099, of course, within 1099 and W2 rather. So if you get 1099, again, you know, they file for a Schedule C, they make 30,000 a year, but then again, you know, they only net or sometimes declare a loss. And then plus combined with their W2. If they are employed, then they could go ahead and get what you call a verification of employment letter. We send that verification out and the employer can put the gross income that he gives that worker, which is a W income gross plus the gross payment on the 1099. We don't go with the Schedule C net. Okay, so that gives that borrower more buying power to get qualified. With this program, the bank doesn't send out the 4506 to verify with rest, no tax returns, no pay stubs. As they just check the validity and authenticity of his employment, how many years they've been in that employee. And also for the self-employed, they will see the CPL, P&L letter, which is a profit and loss. You know, more or less they're going to check it against the bank statements, you know, for the last 2-3 months, just to see if their deposits are in the ballpark figure of what they claim their gross is. And that's all it is. Now, the rates and terms, you have a 7-1 ARM, which starts at 3.95% rate, fully amortized, or you have a 30-year fix, which starts at a 4.25. Not a bad alternative if you can't provide, you know, your docs to qualify. Primary residence has a minimum, or rather it should be a maximum LTV of 80%, minimum of 20% now. So I should change that one there. Minimum, this should be maximum. Oops, sorry about that. Okay. Investment property has a maximum loan to value of 70%. Loan is up to 5 million for purchase and cash outs. I haven't seen that much yet, but hey, listen, if you're somebody with that high net worth, at least this program's available out there, along with other alternatives as well. Okay, let me move on. Any questions about this so far? None? Okay. Gift equity purchase. Now this gift equity purchase is really great when you have a relative selling to another relative. For instance, parents to child, child to parents, uncles, aunts to nephews, nieces, grandparents, you know, and you know how it goes. No cousins, sibling to sibling is fine. They could choose either an FHA loan or a conventional loan. They could go as little as 3.5% down or as much as 20, 30, 40% down. no cash out of pocket to the borrower because they are using equity of that purchase as a down payment. On top of that, the sellers can also pay for closing costs for the borrower. So, if they agreed to say, hey, okay, you know what, the seller only owes $100,000 in the property. He's selling it for $300,000 to his child. And they'll just use whatever that equity is in between to go ahead and use as a down payment. Now, of course, if you need closing costs, they could either add the amount of closing costs to the sales price and make it $310,000, or they'll just get it to whatever remaining equity, and we'll go ahead and play around with the loan to value. So this is great. I've done a number of these loans, and it does work beautifully for those that are selling to direct relatives.
So Jonathan, I got a question on that.
Yeah.
When you say you're using the parent's equity, so that means a child can purchase the property with no money down, that the money
Yes, that is correct.
Okay.
Because we just use the spread, which is going to be like a down payment. So it all depends on the loan amount. So,
And qualifying,
the qualifying is your normal FHA conventional. They have to meet the debt to income ratios and the credit score minimums to qualify for this.
but that would be the child qualifying on their own?
Yes, the child qualifying on their own.
Okay.
No help from the parents. Okay. So
Okay.
the seller cannot go
But they're-
sign for the child. No.
But they're using all of the parents' money.
They're using all
If-
the parents' money. Now, exactly. Now, the parent could also specify they want to net a certain amount in that purchase. So if the parent owes 100, he owes about 150,000. Then the child will have to go with a $250,000 loan plus whatever financing it is, financing to that. So let's make it 260,000 with a purchase price of still 300,000 if you want, or they could bump the purchase price up depending on what the actual value is.
Okay.
And then you can control it that way.
All right. And rates are typical FHA rates?
Yes, depending on what the credit score is, you could go as low as 2.4%. FHA right now is about 2.4, 2.3, 3-year fix with a great FICO score of about 700. That's great for FHA. Or conventional, which is somewhere around the 2.6, 2.75. Again, you know what? The rates are going to be playing around the mid to high twos. They've been inching up the last 2 days, but a couple of days ago, wow, they're really great.
Excellent. Thank you.
You're welcome. Next loan program, Home Possible. Now, the Home Possible program are for first-time home buyers. The only reason we want to go Home Possible program, let's say if you want to avoid the high PMI, PMI premiums of FHA, we may want to explore this first. Minimum of 3% down. If you're buying units, you could go up to 5% down for units. Now, this one, however, caps you at a 45% debt to income ratio. So, and it has an income restriction. So for most places, I see the income restriction is somewhere in the vicinity of about $58,000 to $62,000 a year. We have to run the property through the census tract. There are some properties around little pockets. There's a little pocket in Torrance, a little pocket in Southgate, wherein there are no income restrictions. That's great. But if the property is within, most of the areas have income restrictions, then we're limited to what the income restriction is. So we haven't been successful yet in meeting the income restrictions, except for one borrower that I've done last year. For the most part, I tried putting 10 in. A lot of them are making like $500 above income restrictions. So guess what? We have to go with the regular, 5% down, or we have to go with FHA. All right. Again, conforming loan limits apply, 30-year term, only for owner occupied, and they have to be first-time buyers only. No, not a second-time buyer. What constitutes a first-time home buyer? He could have owned a home more than 3 years ago. As long as that house has been sold, no more mortgages in more than 3 years, he's considered a first-time buyer again. He resets into that. Okay. All right. Your regular conventional loan. When I say no titles, a lot of the loans coming in right now, I say more than half the loans are still, refinancing. So the homeowner sometimes is deficient in income, and they might need a push for co-signers. So their kids are now grown and have been at work for at least 2 years. I see a lot of that. So they want to bring the kid into the loan and help them qualify. So there's no title seasoning for the added borrower when refinancing. The added borrower could be a non-owner occupant as long as the refinancing is not a cash out. If it is a cash out refi, then the co-borrower will have to be living in the property. You know, again, regular documents are needed, your W-2s. Tax returns are required if you file a Schedule C. A Schedule E is for rental income, or K1 income, you know, income filed, which is sometimes with an S corp and all that stuff. Bankruptcy, you know, seasoning for conventional is 4 years. 2 years from discharge for the BK13. There are 2 types of bankruptcy, BK7 and 13. Foreclosures, if you had a foreclosed property before, 7 years seasoning. All right, 4 years if it's been, you know, in lieu or foreclosure or short sale, they need 4 years. Now, with extenuating circumstances, they could cut it down in half for both BKs and foreclosed. But, you know, again, it all depends on the extenuating circumstance. Maximum DTI, debt to income, is up to 49.99% on the back end, as long as the front end is 46. Let me explain that. Your 46 front end, the way it's computed is whatever the future housing payment divided by the income, you know, is what you call a front end ratio, and that should not exceed 46%. If your back end ratio is maxed out at 49.99, and the back end ratio is computed as future housing payment plus existing monthly debts like car payments, student loans, and credit cards, divided by the income, should not exceed 49.99 with conventional. All right. So moving on here. 203K rehab loan. 203K rehab loan is still an FHA loan. It's a great loan for those buyers that are seeking to purchase, you know, distressed properties, maybe fixer-uppers and all that. The good thing about a 203K rehab is that when they're competing against cash borrowers, or usually investors tend to lowball the property but pay for it in cash. If the seller isn't that, you know, how would I say, stressed out and having to sell the property immediately, not that desperate, then they may opt for a 203K owner borrower who can actually offer a much higher price than that of the investor. And what does it entail? A 203K streamlined rehab loan are limited to the following rehab or update, or what do you call it? Carpet, minor termite damage, counters, cabinets, patching holes and doors, you know, installation of HVAC, just like what we did with Danny's home the other time, lead-based paint, abatement painting, you know, installation of new appliances. Maximum rehab costs, they're going to allot to that is about $35,000. So the way it's computed is, let's say the purchase price is $300,000. So we'll put at $335,000, and 3.5% of that will be your down payment. And that's about it. They'll leave that $35,000 in escrow. Your contractor will have to be, you know, the one to draw that out, and it will have to be a licensed contractor in good standing to do the work for you. You can't do the work on your own. There are some banks that will allow you to do the work on your own, but you will have to be under the supervision of a licensed contractor. But for the most part, the lender overlays is want a licensed contractor there. Along with what is needed is a copy of the estimate for the labor and the materials. And of course, there are extra paperwork that we would have to go through because the building and safety would have to sign off on some of the documents. So usually at time for this, we ask for 45 days, but with a new protocol, sometimes, you know, I'm not very confident sometimes that it may go 45 days. I think we'll need a little bit more, but no more than 60 days on a loan like this. Okay. Any questions so far with 203K? Good. All right. FHA loans, always dependable FHA loan. Rates have dropped only for those with really good credit standing. However, with those that don't have so much, you know, good credit standing, we also have those lending sources. Minimum of 3.5% down. Back end ratio can go up to 55%. However, to do the front end cannot exceed 46.9%. Okay. Minimum credit score is 580. You get the better rates when your score is 640 and above. Rates start to go really high, and plus some points if you're below 620, all the way down to 580. Single family up to 4 units, fine. No credit is okay as long as you have a cosigner that does have credit scores, 3 credit minimum. No reserves are okay, 100% gift funds, fine. I've seen 550 FICO scores before. I've only been successful in doing one, but it's hell getting it through. It's going to be a manual underwrite. If they have a 550, they're going to look at the credit, performance and the reasons behind why that score is that low. There's a minimum of 10% down with 6 months reserves needed, and strictly 3143. You can't go over 0.01% above the debt to income ratio of 31/43. Now, if the borrower meets all of that criteria, they could go in with a 550 FICO. So, let's not scratch off those, bad credit borrowers that you have right now lingering around. And they may have actually the resources to make it happen with FHA. BK seasoning is only 2 years. Foreclosures is 3 years. Seller can pay for up to 6% of sales price. That's a lot, with prices. So you could actually pay for all the closing costs and reserves. All right, FHA, that's FHA. Moving along. VA loans. I don't know how many of you have done VA loans, if that's a pretty popular loan for you guys. I've done quite a number of them this past year. I intend to do a few of them again this year. VA loans are very good. I've closed rates down to 2.25, 2.3 for 30-year fix. Seller has to at least pay a minimum of 1% towards the loan. If they don't contribute 1% into closing costs for the borrower, then we're going to have to charge the borrower, and his rate's going to get bumped up to a little bit higher rate. Minimum credit score is 580, but best rates are at 620 and above. BK 2 years. BK 13 seasoning is 1 year with the court permission. You don't have to wait for the full 4 years to finish up your BK 13. As long as you've been on time paying, your creditors for about a year, get a court permission. If you're willing to go through that process, we could do it. Single family condos, townhomes, new constructions, manufactured homes, and units. The beauty about VA is no PMI. Seller can pay 100% of the closing costs, no reserves required, no credit, okay, as long as the spouse has credit scores again. The bottom line is, the main borrower, if he doesn't have a credit, co-borrower has to have credit scores. A spouse of a deceased vet may qualify and use his VA benefit. Okay, VA is great. Now, the thing is, a lot of you may think, hey, VA is going to take a long time. The last 2 VAs I did, I was able to close in 30 days because number one, the borrowers were impeccable. The ratios were high, but it wasn't, we got them pre-approved before that. But everything else was great. The listing, the seller, and the buyer's agent, we were all working in harmony to get this thing done. What was requested for was given to me that same day. That makes quite a big difference in closing your deal on time or before escrow expires. So it makes a good team make that happen. Now, here's a list of FHA and VA repairs. Just so that you know, whenever you have an FHA or a VA loan, you have a listing, you may have to go FHA. Look out for peeling paints around the home, especially built before 1978. Because before 1978, they need the paint, lead-based paint disclosure and all that stuff. Unpainted spouts, broken rain gutters, rotting out buildings in need of demolition. These are the bigger, look out for these type of deficiencies in your home. It would save you a lot of trouble if maybe the seller can fix up his home a bit, before putting in the market. You might even get a better price if that's done that way. I'm sure you guys know that. But if you're accepting an FHA VA loan, prepare to make these repairs if you see it visible on your listing. Okay. And I'm going to be giving you a list of this after the presentation anyway. So bedrooms without minimized size windows, that, the security bars, sometimes they don't have a release hatch, auto release hatch. That's a safety issue. Foundation and structural defects, okay, that's pretty bad. Wet basements, sometimes they can see evidence of leakage when they look at the ceiling and there's like a little stain in there. That's a red flag. Inoperable kitchen appliances. Did you know that when you're doing FHA or VA loan, you have to have a gas stove installed there, properly installed, because they're going to check out, how you are connected to the gas line and make sure it's really secured. If you don't have a stove in there, they're going to condition for a stove to be placed, and they're going to have to go back out and re-inspect the property. That's going to cost your buyer about $175 extra for re-inspection. So, rip screens. I've seen those rip screens before. Sometimes it's best if you only have one rip, what do you call that? Those screens in the window screens. Let's just take out that window screen, and that way it's no issue. We've done that before. This house had very old screens. I just told the seller, worst case scenario, we're going to have to replace the screens anyway. So why don't we, before the inspection, just get all the screens out? And the seller says, well, yeah, we could do that, but I'm not going to spend for, any of the, the screens. The buyers has to spend for that. The buyer said, yeah, I'm willing to. Well, we were very happy that when the appraiser went out there, he then conditioned for the screens to be installed immediately. The buyer is quite happy about that, because the buyer says, hey, you know what? I don't need all the screens installed, just a few of them anyway. So that worked out for them. Okay. Leaning and broken fence, very important. You might think that the fence, on the side of the properties might not be an issue, but they are, because it's a safety issue if it looks very unstable. That's about it. I had a property wherein on the patio, it had a deep drop, into a second level of a garden or something. And the appraiser wanted the buyer to, or the homeowner rather, to install at least a wooden fence or a barrier on the edge of that deep, incline or decline of the ground. So they had to do that. All right, moving on. 2021 loan limits. Oh my gosh, we've increased a lot. Check this out. So conforming loan limits 548,250. This means that rates are going to be about an eighth lower than if it was above 548,250. High balance cap is at 822. Almost $100,000 increase from the last time. Very good. I mean, rates right now for this month is about 2.6, 2.75. Here would be about 2.6, 2.5 as of, a couple of days ago. Today we might be about an eighth higher than that. 2 units up to 1.53, 3 units, 4 units. Now, for San Bernardino and Riverside counties, this is the cap here. Anything in excess of this loan amount is considered jumbo. And so you can no longer apply for a Fannie Mae, Freddie Mac, or an FHA loan if it exceeds this loan amount in those counties, San Bernardino and Riverside. Okay, just keep in mind. Okay, scores and rates. The credit scores could affect your rate. Say 740 and up, as long as we hit 740, you're there. FHA is 2.464, conventional is 2.5, 0 points. 700 to 739, again, FHA is the same, about a bump of an eighth with conventional loan. 660 to 669, you see the rate increase. 2.99 for conventional. 640 to 659, FHA now goes up to 3.25, conventional goes up to 3.5 with a point charge. 620 to 339, look how much they go up to. It was shocking at today's really, really low rates, but guess what? 3.75, we were killing for that rate not too long ago, right? So that's how credit scores affect the rates. What affects your credit scores? Here's the chart. Your payment history is the biggest chunk of that. Next is how much the amount is owed. For the most part, if the balance of your credit cards, revolving credit cards, are like 30% or more to what the credit limit is, it starts eating away, chipping away your good credit standing. So you'd like to advise your clients to keep that balance down to 30% of what the credit limit is. Okay. Now, there is a difference between installment payments and revolving debt. Installment payments, it's finite. It's either a car payment, which is up to 5 years, 4 years, 6 years. It doesn't affect the credit score unless they get, they fall they have 30-day late on it. Other than that, it doesn't affect their credit score. So they have to be very mindful about their balance. Length of credit, of course, the longer they have their credit card, the more established they are. I would recommend that they do close credit cards during the time that they're refinancing, because when you do close a credit card account, it does take away from your credit score. When you do a new credit, it shows an inquiry on your credit report. And if you do that a number of times, like once or twice or 3 times within 30 days, it could take away about 10 to 15 to 20 points from your credit score. So be very mindful of them, again, not having to inquire about any new credit at that time. And the types of credit used, that plays a small part of establishing what the credit score is as well. All right, guys, so no questions here. Let's move on. Art of the deal. Okay, now the art of the deal, listing agent, or maybe if you're a buyer's agent. Let me show you some examples here. Let's say you have a listing, 750,000, buyer's putting 10% down. That's a loan amount. 2.625. He's paying for his closing costs and everything and down payment. This is how much funds he has to bring in to close. Now, if he's deficient, he says, you know what, I don't have that much. And if you're the listing agent, if you could accommodate a $10,000 increase on your listing price, and if you're the buyer's agent, rather than lowballing the price at this time, and it's multiple offer situation, I doubt very much if you're going to get that lender, that seller credit. So, you have to at least meet them, where what they want to net, plus add on whatever the financing charge. This one approximately about $10,000. So we add that to the listing price, which is $760, as long as the value can hold. $760, you check it out. Their loan amount will be about $684, almost $10,000. It's $9,000 more. For the same rate, they're only coming down with $78,000, which is $9,000 less. And, which now could meet the buyer's ability to at least bring in the funds. And how much more does it bump up the payment? Not really very much. They need like about $50, but he was able to finance $9,000 worth of cost by adding the $10,000, into the price. Now, if the seller doesn't have that, they don't want that option, and maybe the value can't hold, you have another option we're in. If you have really good credit, we could, as a lender, credit back at least around $8,000 into the deal. And the way that's done is we have to bump up the rate. Today's rate is about 2.99. That would give us enough money to play with to at least credit back the buyer $8,000 of his cost. In which case, it brings, all he has to come up with is about $79,000, which is $8,000 less. Then I have to go on his own, leave with the original deal. Monthly payment is going to be roughly around $190,000, $190 compared to, buying it as is. Okay, so that's how much his total monthly payment is. And let me give you the breakdown of the monthly payments. Here's the principal and interest, property tax, has insurance. Fire insurance, we always estimate it at 0.25% of what the loan amount is. However, we go by the final amount of what the insurance provider gives us, and that's the amount that we use. I see that with San Bernardino and Riverside counties, their insurance have more than doubled. They're actually paying like about $1,500 to $2,000 per year in their premium, much more than properties in LA and in Orange County. You know, there's some parts in LA where, you know, the fire just, they were ravaged by the fire, that their insurance increased. Mortgage insurance here, depending on the credit score, again, this 10% is about 0.24% of what the loan amount is. The good thing about mortgage insurance, when you have really good credit and you're putting 10% down, eventually, you know, your property is going to, you know, increase in value. And let's say within at least a 5-year minimum, you know, you would have enough equity into the property, maybe 20%, 25% equity in there. At that point in time, the lender could drop this PMI. So there's an additional savings of 129. There is a program which is called a lender paid MI, wherein they're not gonna charge you the monthly premium, but they're gonna bump up the rate. Usually it's about a bump of about 0.25%. So the monthly payment is gonna be lower even with a higher rate. However, that higher rate is gonna be for the term of the loan, regardless. So long term, you know, if you're putting 10, 15% down, you might just be better off having to go with with mortgage insurance, because you're assured that somewhere in time you're going to be able to drop that and save about $129 a month. Okay, let's see. That's pretty much in a nutshell my presentation for today with these updated what do you call this, loan programs. Any questions so far? Yes. All right.
Hey, Jonathan, what's your take on the interest rates here going forward?
I think interest rates are still going to be pretty low. I've read on a newsletter not too long ago that there might be a little bump up on the rates when there usually is a one-party rule, which in this case right now it's the, you know, one party is absolutely what do you call this, in control over the other party. The banks get nervous because then again, you know, it may affect whatever they decide in terms of the economies and all that stuff. It somehow will affect the bond market. I'm not an expert, but what I read is if it affects the bond market and the treasury in a way that has an adverse effect on the rates. So far, I haven't seen that yet. I mean, you know, rates have been holding steady. So, but my take on it, you know, based on so far the transition of power and rates still being low, I think we're going to be holding on to these rates for a little bit longer. And I'm hoping we do. The only thing is for you guys that are selling property is the lower the rate, the more competition you're going to have. And we're going to see a lot of multiple offers and prices might still keep going up in terms of value and a law of supply and demand. So, you know, I don't know if I want to keep the rates really that low for so long.
Yeah, and as you know, whenever the rates bump up, let's say if they go up 0.25%, that always, the market spikes because everybody gets off the fence to do their either the refi or their purchase.
Exactly. There was this one buyer I had that was, you know, said, I'll wait till next year. Well, he waited till next year. Homes that were selling at about $650, he was looking in Eastvale. That's, I think, Chino. The homes that were selling around $625, $650 are now in the $750 range, $725 to $750 range. And he goes, how can people afford? And I did the math during the time that he was looking into properties. Rates were at like about 3.5 to 3.75. Today, rates are 2.5, 2.625. So when I did the calculation with the same income that he had between then and now, he's actually more qualified by about 100,000. Yeah. So see how the rates do affect the qualification of those people that are now able to afford a higher price home. And then now there's a price war, you know.
Yeah, so, we're still seeing multiple offers on the, especially on the lower end properties. And just as a little tip here, we're going to give you more info at our monthly meeting here next week. But 2020, there were more sales in California for that year than the previous, it was higher last year than the previous 10 years, any other year in the last 10 years, which is pretty amazing when we look at our company, when we had a lot of agents basically not working. This market is incredible. And I know, like for Keith and Carol that have been out there for a while, this is about as good as it gets.
Yeah. Yeah. You know what? It's going to take a while before we get this its way again. So let's strike while the iron's hot, really.
Yeah. Yeah. Carol, you had a question?
Yeah, Jonathan, So we still have a lot of complexes that are not FHA approved. How difficult is it to get a spot approval now?
Good question. I haven't had a spot approval, transaction yet. Just when I thought I would have, they decide to go conventional. So I wouldn't know how to answer that, but from my past experience, which was a long time ago, spot approval wasn't really that difficult. It goes through a process, and it took maybe a couple of weeks for us to get the complex spot approved, as long as the HOA is willing to do what they have to do, and they're efficient, and sorry about that, and they're efficient in giving us the documentation needed.
Got it.
Yeah, so that's something we'll
Most of the
have to,
Most of the documentation you need is stuff that you need for the escrow anyway, right?
escrow and HOA. Yeah, we'd like to
Yeah.
see the financials. We'd like to see how many FHA properties are in the complex. How many are being rented out, investment versus primary homes in there. That type of stuff.
And
I just
Jonathan,
know that
if you saw that there's a message there also from Lorraine on
Okay.
FHA repairs.
Okay. Could you read that out to me, Durf? I don't see that message.
Sure. On the chat. So Lorraine, I'm not sure what you're asking. It says, but it said repairs before closing for FHA. Can it be a credit?
Good question. No, it can't be a credit. And if you're going to ask for a credit, let's say of $5,000 to do the repairs, first of all, the repairs will have to be done. If it has been conditioned by the appraiser, you're going to have to do the repairs. It's got to be completed, and the appraiser will have to go out there, inspect, sign that off for us to be able to order docs.
Yeah.
With that said, let's say, for instance, if there are repairs that are actually not conditioned for by the appraiser, because that happens a lot, they could, if the seller is willing to do a credit of, let's say, $5,000, you have to credit that towards the closing cost of the buyer and not stipulate that it's for repair credit. The bank doesn't want to see that because they don't want to sell a concession that way. So for any credit, make sure it's towards towards closing cost of the buyer.
So just to repeat yourself there, Jonathan. So if it's a lender required item, those have to be done before escrow. But if it's something that the buyer picked up in their inspections, then that can be worked out as a credit towards closing costs.
Yes, absolutely.
All right, thank you.
You're welcome. Any other questions you see there?
Oh, looks like everybody.
What about the termite? Is it mandatory in FHA? I know it's not mandatory.
Oh yeah, good question there. No, termites not
Good question,
mandatory.
Lorraine.
It's not mandatory. So if you have a termite waiver for FHA, make sure you don't provide escrow, don't provide me with any termite reports. We don't want to see that. All we need is a termite waiver signed by both parties. For VA, it's a different story. Whether you like it or not, they're going to require a termite report, and if repairs have to be done at termite completion. Okay.
Is that new, Jonathan? Because I don't, I think
it's
about a
always-
year ago, you said some of the FHA programs were requesting termite, although most were not, but I did not know that that was a requirement for VA.
Right, 100% requirement for VA. With FHA, there are times, okay, even if, let's say, for instance, the appraiser goes out there, does not condition for anything, there are times that the underwriter is going to overrule that report, that appraisal report, because they might see evidence of maybe a chip, stucco in a corner, or the roof might be covered with leaves of some sort, and the underwriter will condition for those to get fixed, override the appraiser, and then we're going to have a reinspection for that. And there are other times, not too often, the underwriter will request for a copy of the home inspection. I've had that done only once in the last.
Oh wow! I've never asked had that asked of me before.
Right. It's not very common, but if the house does show some red flags in it, and sometimes the appraiser could be, I guess, very generous in his appraisal report. if the underwriter spots something in there, they could condition for that. So it's at the discretion of the underwriter, really. You know, for the most part, that only happened once with me. That's it. Of course, it got all the parties very frustrated, but hey, what can I do? You know, I'm just a messenger. But,
Hey, and Jonathan, what's your take on appraisals? Because it's been my experience in this last year with this, you know, big push, this big increase in prices, that most of the appraisals that I've run across for our agents have been good. It hasn't, not like years ago where we always had to fight with these appraisals. Obviously, there's still some that don't make it, but it seems like they've been getting better, and they're factoring in this market increase, even though there may not be any actual comps at that highest price.
right. Well, you know what? So far last year, I only had one appraisal that didn't come in, and you know
That's
what?
amazing.
Yeah, exactly. And what I had done with that appraisal is, because I have the capability of brokering it out from one lender to the next. And we also do the fundings, you know, we are brokers and we're also direct funders. So what happened is I did submit that to one of our lending sources. The appraisal came in like $10,000 below value. And everybody was shocked. And instead of having to rebut that appraisal, I decided to just pull it out of that lender and told them, hey, listen, it's better, let's just, you know, extend escrow on this one and let's see what we could do with another lender. And when we did the other appraisal, chose another AMC. So we got rid of that AMC, whoever did that appraisal. The property came up $5,000 more than the agreed price. Can you imagine that? So there was a big disparity between one AMC company versus the next. So, you know, everybody was willing to cooperate, and that worked out for everybody. You know, they didn't have to reduce the price or do anything, and everybody was happy.
Well, good. I'm glad you're experiencing that also.
Right. Right.
Any
So
other
far,
questions, comments from anybody?
commercial loans, if you got commercial loans as well, let me know. I've got somebody, Michael, who's been my partner with the commercial loans. He's the expert, and we could always refer that over to him. You know, if you have inquiries or listings about it, feel free to ask questions. I'll forward that over to him for any answers.
Yep, and then next
Okay.
week we have our office meeting, and then Stu is doing our lunch and learn on taxes, which I think everybody needs a education on for the new 2020 and 2021 tax years. So thanks for joining us, everybody.
I'm going to be there. I need that.
All right, see you guys.
All right, guys. Have a good day. Bye-bye.